we had enough unpredictability anyway without this. And I had become pretty confident that we were, from a psychological point of view, running through the usual game. And we were losing confidence in the high flyers, losing confidence in the super specs. And I thought the probability of a recession in the next year or two was pretty high. And I thought sooner or later, with all the debt around, that is going to trigger at least a partial financial crisis. So you have a plentiful supply of big negatives that could happen. And as you get out a year or two, you get into this field where I think the long-term outlook for inflation is really quite bad, because we are basically running out of resources. This time is different. But really, the 5 most dangerous words were "this time is never different." Because from time to time, things absolutely change. And they changed in the early 21st century. And we went to a regime of kind of corporate paradise where PEs were not just higher than the previous 60 years, they averaged 60% higher, where profit margins were not just higher, but they averaged close to 40% higher. So profits as a percentage of GDP went up several points, and wages as a percentage of GDP fell a few points. So these are profound differences, and they were accompanied by the lowest interest rates in the history of man, which declined for they declined for 50 years, but they declined the entire 21st century. Almost a half of the NASDAQ stocks are down 50% from their high. And the 1 or 2 of the superstars, of the craziest ones, had already started down when we spoke. My favorite, QuantumScape, a SPAC that came at 10, went to 130, worth $55 billion, with 4 years still to wait before they had any revenues, forget profits. And the biggest holding I had ever had in my life. It made me personally, to be blunt, a quick $500 million on paper, but it couldn't be sold for 6 months. And I opined that it would probably not get to the 6 months. And by the time the 6 months was up, it was down to 25. So it was down 80%. Today it's 15. And that has led the charge. But by the middle of last year, it was joined by a lot of the AMCs, the Bitcoins, and the GameStops, the meme stocks in short, the meme ideas, since Bitcoin isn't a stock. And they kind of peeled off and joined in. The whole SPAC index was a disaster. The Cathy Woods ETF went down 50-60%. And they were the more exciting stocks of the previous year. And this is eerily like 2000. In 2000, the growth stocks, the TMTs they call them, technology, media, and telecom, they peeled off, starting with the flakiest and most speculative first, the ones who tripled the year before. And then it worked the way through the system until it finally got to Cisco. But by the fall, they were down badly, and the rest of the market was still up. So the S&P, on September the 1st, to be exact, I looked at it yesterday, got back to where it had been in March. And the NASDAQ itself, off a big hit, had a big rally in the summer. And then the whole thing rolled over and everything went down 50%. Incidentally, the ones that had been hit by 30 or 40% also went down 50% from a worse starting point. So the NASDAQ ended up minus 82. And that pattern has been creepily like the one we've been watching. So that 12 months ago, yes, the S&P is still up 16%, but the Russell 2000 is down. And that's the one we short against our huge holding of VC. And so that hasn't been nearly as painful as you would suggest. Suddenly the world has changed a bit. And as a historian, I can say with confidence that these geopolitical events are murderously difficult to predict. If you could tell me how long it would last. Even then it would be difficult. But it could, in a month, they could have a regime change in Russia, and we could be in a honeymoon period again. Or this could drag on to be absolutely the start of a multi-year super cold war, and it would have repercussions everywhere. Wars are not obviously bad for stock markets. They do set in process a lot of capex, a lot of new products, a lot of war profiteering, if you will. So it isn't necessarily a doom for the stock market. It's a miserable time for everybody else, but in wartime, people do work harder and produce more. The cheapest copper ores and lithium, cobalt, nickel, the stuff you need to electrify the system, they've all gone. We have no great capex projects up our sleeve. We've actually, since China slowed down in 2011, the capex has dwindled way down. There aren't plentiful reserves. So as we gear up to decarbonize, we'll be bumping our head, almost guaranteed, on shortages from time to time of these critical metals. And then you have the problem of labor, which in a short-term basis, everyone's saying, where have they all gone? But in a long-term basis, I can tell you where they've gone. They were never born. There is no improvement in the baby output over the last 20 years. We have slightly been declining. So we can guarantee, since they're already alive, that the supply of 20-year-olds entering the market in the developed world, in the US and in China, will be declining. The UN Food Index is back to those highs of 2011. And Ukraine is not a bystander. Ukraine is part of the great breadbasket of Europe. It's where wheat comes from into the export market. So if you're an Egyptian, half your imported wheat comes from the Ukraine. So this is entirely relevant. And you add together the change in the weather. At least in the Arab Spring, people weren't obsessing about floods, droughts, and higher temperatures. But that has become painfully more obvious in the last 10 years. And it's making agriculture very difficult. The system is so complicated, they're always different. But I think the last 20 years has been completely different. Indeed, I wrote a quarterly letter in 2017 saying I couldn't find anything that wasn't different. And that the four most dangerous words in investing were not. This is totally unlike the Goldilocks era of the last 20 years, or indeed the post-World War II era. We've had a plentiful supply of new labor. And in Japan, of course, we had all those semi-redundant farmers plowing into the cities and getting plugged into a very efficient, hardworking capitalist system. 500 million of them, and then 200 million Eastern Europeans actually starting to seriously work. So that completely glutted, if you will, the global labor market and put pressure on labor everywhere. And now you wave your magic wand and you find quite abruptly China's gone from an excess labor supply to a shortage around the corner.